Good afternoon, and welcome to the Trident Royalties PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to CEO Adam Davidson. Good afternoon to you.
Hi, good afternoon, everybody, and thanks for joining the webinar. I will actually start a little bit through the slide deck, but as preface, this is the same slide deck that we've got on our website, so this is all available for you to download and peruse at your leisure. Standard disclaimer, I will let everybody read that on their own time. And I think as most of the people on this call are familiar with Trident, we thought we would focus on a few different topics this time rather than do our general run through of royalties. There's quite a bit of material and videos on our website. So if you are new to the royalty model, I encourage you to spend some time on tridentroyalties.com. But I'll hand it over to Richard, because what we would like to do is to touch on Trident's strategy specifically and a couple other points before then jumping into some of the progress we've seen in the portfolio over the course of this year and then the recent transaction we announced this week.
Great, thank you, Adam. Just to start by talking you through Trident's approach. So obviously the royalty sector is a very large sector, about $80 billion in market capitalization, but the bulk of that market cap is focused on precious metals. So if you look at the bottom left chart, about 90% of the mining royalty sector is precious focused, and a large portion of that is the three big North American companies that particularly dominate the sector in the Americas. So there's only a very small sliver of the sector that is focused on all commodities, about 7%. And even of that 7%, there are a number of big single asset iron ore royalty companies, both in Australia and Canada. So the way we look at it, we're fishing in a less competitive pool, but we're still focused on a huge area of the mining sector. Because the mining sector itself is broadly split in equal parts between precious metals, base metals, and bulks and battery metals. So that gives us a lot of potential and a lot of runway to go at. So when we look at commodities, we're relatively agnostic. We'll look at both base metals, battery metals, and we'll also selectively look at acquisitions in the precious metals space, but recognizing that is quite a competitive market. Then just on slide 10, touching on the history of the company and how we've allocated capital, you see on this chart, we've got the different deals that have been done over the past 2.5, getting on for 3 years. The company's been in existence. As you can see, as we've added assets and grown accretively and reinvested our cash flow, the share price has gone up and to the right, which is great. But we've also had a good increase in liquidity, which is very important for bigger shareholders and institutions, so they can buy larger blocks on market and trade in and out as they see fit. And just touching briefly on our portfolio, we've got just under 20 assets. But I think what really sets us apart is that 13 of those are now cash flowing. So that's a very broad and diverse portfolio of cash flow, and very different from a mining operator of our size that would probably have one cash flowing asset. So our cash flow is nicely spread between different assets and also different geographical areas of the world. And when you look at our portfolio, about 2/3 of it is located in Canada, the US, and Australia. So all very stable, well-established mining jurisdictions. And just touching on our partners, so the companies that actually operate the assets that we generate royalties from, and there's some of the biggest names in the industry. So Lithium Americas is a multi-billion-dollar project developer. Ganfeng is one of China's largest lithium companies. Equinox and Victoria and Silver Lake, they're all very well-established mid-cap gold companies. Moxico is private, but again, it's a pretty well-established business. So there's some really good management teams with a lot of access to capital running these assets and really helping drive our royalty revenue and future upside through exploration and other things. Just touching on our portfolio. So we are at present roughly split just over half of our asset base is in the battery metal space, about 15% is in base metals, and the balance is precious. And when you look at the chart on the right, so that's our revenue profile looking out into the future. We have a base load of precious metals revenue, which we get from our offtake portfolio. And then as we move forward over the next 2 to 3 years, you can see the uplift as the lithium assets come on stream, so Thacker Pass and then hopefully Sonora. And that drives what is a pretty material growth in cash flow as we look forward to the middle of the decade. And again, these cash flows come through with very limited additional payment from our side. There's obviously still a payment to be made on Sonora, but the other assets are in the portfolio and ramping up. And just touching on the sector more broadly, you can see on the chart on the left the performance through 2022. And as we outlined earlier, given some of the deals we've done and the performance of our assets and the sort of the development steps that have been made over the last year, which have been pretty important. Trident was the best performing royalty and streaming business. Then when you look across to the right-hand chart on a price to NAV, so evaluation basis, we're still rated somewhere near the bottom of the chart. The three bigger companies I referenced in the precious metals arena, so Franco, Royal Gold and Wheaton, currently trading about 2 times NAV. And I think there's a reason for that, given the scale of those businesses. There's a huge amount of inbuilt optionality in their portfolios. They have assets that have multi-decade lives, and they're constantly able to reinvest that cash flow, buy new assets, and build those businesses. So there's certainly a premium to the scale and the quality of those businesses. When you look further down the list, the mid-cap royalty businesses are sort of trading at 1 to 1.5 times NAV. And then we're down there just under 0.75. I think the key reason for that discount, one is size, but also the fact that we've got a number of assets that are in the development phase. So as those assets come through and into production, we'd certainly expect to re-rate somewhere towards the middle of the pack. So with that, I'll just hand back to Adam to talk about the 2023 updates.
Yep, thanks, Richard. I think 2023 has been a pretty material year for us, and we're obviously only into May. But some of these news items have been pretty substantive for Trident and worth reiterating. You'll see quite a few of them dominated by the news on Thacker Pass. I'd encourage people to go to our website because we obviously press release all this in detail, but worth rehashing here with everybody on the webinar. I think the first event that was very material was obviously General Motors committing to jointly invest to develop the project, committing up to $650 million. Now that $650 million is contingent on a couple items. The first was the second bullet point here, the favorable ruling from the federal court that regarding the federal permit for Thacker Pass. So with the favorable resolution there, the first tranche of the General Motors money has been released, and the project has commenced construction as of March. The second tranche of that funding is linked effectively to Lithium Americas, the operator of the asset, bifurcating the company between their Argentinian assets and then Thacker Pass in the U.S. Lithium Americas actually provided an update on this very topic this week, and it's very clearly moving in the right direction. And they see it as very much linked to their application for the Department of Energy loan program that they see as funding the balance of the construction cost for the project. So it's a pretty momentous event from our perspective. I think a lot of people who are on this webinar that are shareholders already may have invested out of their interest in assets like this. I think the way we look at the world in general is some of our very big gold peers that Richard made reference to, within their portfolios, maybe sort of 5 to a dozen kind of Thacker Pass equivalents. And what we see as a very clear opportunity on the non-precious side is building a portfolio of that size and scale on the non-precious segment of the mining sector, and these opportunities are out there. Had that been a Nevada gold royalty, clearly we wouldn't have had the opportunity to acquire it. We would have been outbid. These very large players have much lower cost of capital, but it's really underscores Trident's strategy in general, the fact that these opportunities are out there, and if you can aggregate enough of them into the portfolio, see them de-risked and enter into production and therefore cash flow for us as the royalty holder, these are pretty momentous events. And as we scale the business, we see that unlocking quite a bit of value. And we've said it many times, but I guess that the fact that you've got multi-billion-dollar market cap gold-focused royalty companies, with gold being a third or less of the broader mining sector, there's just a very clear opportunity to grow a multi-billion-dollar diversified mining royalty company, and we see Thacker Pass as very much validation of that strategy. Also in February, we completed the sale of some of our exploration stage pre-production gold royalties. We've said as well, we're not in the business of trading royalties. We don't typically like to cleave off royalties. This is the first time we've done so. That said, the valuation was very compelling. We were able to sell it to the largest gold-focused royalty company. Obviously, they trade on different multiples than us, so there's value arbitrage there. And from our perspective, we bought these royalties for an aggregate about $6.25 million, sold them for just over $15.5 million, 14.3 of which was paid to us in February. The remaining $1.25 million would be linked to production from one of the underlying assets. So from our perspective, that allows us to redeploy that capital into other acquisitions with a compelling return profile, minimize dilution within our portfolio. And as we've always flagged, we see the real core of opportunity in non-precious metals, particularly in base and battery metals, where we want to remain opportunistic with regards to precious metals royalties. I think this transaction underscored exactly why, because there is value to be unlocked. We also commenced trading on the OTCQX. This was a natural segue with one of our key assets being located in the US. And we see quite a few peers that get good liquidity out of the OTC. So this is a net positive for all shareholders. There's no additional reporting requirements. It's all effectively mirrored onto the OTC. So very, very incremental cost to us, very minimal taxation on our resources internally. But should provide enhanced liquidity. It's going to take time to grow that platform, but we're pretty encouraged by some of the feedback we've been getting from the early stages of marketing across the U.S. and North America more broadly. We also had obviously a ruling from the Alberta Court of Appeals on Sonora. It was not the judgment we were hoping to hear. Effectively, the judge ruled to uphold an appeal against the royalty holder. So stepping back, we've got effectively what amounts to a synthetic option to buy in half of the royalty. We structured it that way for the specific reason, because the royalty is in litigation and in dispute. And effectively, the way it's structured is if the court rules against the royalty holder, we've put down a deposit, it's collateralized, and we can extricate ourselves, get our money back, and kind of no harm, no foul. But if the court rules in the royalty holder's favor, which our analysis is positive on, we were hoping this appeal would accelerate that process, but now we'll have to go through the full litigation process. But assuming that it comes out in the right direction, then we have the ability to execute on that to buy up to 50% of the royalty. And it's on a similar size and scale to Thacker Pass with regards to cash flow, a smaller planned production profile, slightly sooner to cash flow is the expectation, given the operator Ganfeng has flagged that they've commenced construction last year. But it also produces a slightly different product in that it's hydroxide, which has oscillated, but tends to trade at a sort of 10 to 20% premium to carbonate. So from a cash flow perspective, and the fact that the royalty is a larger percentage, we see it sort of potentially mirroring Thacker Pass style cash flows. And then one of the final points is our Q1 results worth flagging. It was our record royalty receipts. we've been pretty encouraged that over the last several quarters, each quarter we're able to flag a record quarterly receipts as we see some of these assets step up. We weren't sure if this would be the case in Q1 because particularly with our gold offtakes, a lot of producers try to cram through as much production at the very tail end of the year for their reporting. So you tend to see things taper into Q1, but I think between the strong gold price and then very strong deliveries, in fact, we had a fantastic quarter. And a very pleasant surprise, given it's a slightly opaque royalty, as our Cooley-Nobbing iron ore royalty delivered its highest quarterly payment to date at about $800,000 US. So pretty significant step up there. The last bullet point will lead me into the next slide here. The recent acquisition we made this week on the La Preciosa silver project. So by way of background on this one, La Preciosa is owned by Avino Gold and Silver, Silver and Gold Mines, which operates the neighboring Avino mine. Avino's been operating for circa 55 years, so very experienced team and operating obviously in that part of the world and very successful in that regard. Now, the way this transaction came to fruition was Core Mining, which is a good mid-tier plus $1 billion market cap company. They had acquired this property about 10 years ago in a transaction valued at $350 million. So it's a very substantial silver asset. Subsequently, they had planned a large open pit project, and it's subsequently evolved. I think effectively found that would be challenging with community and everything else in terms of permitting, whereas an underground operation is very suitable for this deposit. So effectively, Core sold the asset to Avino, who's the natural holder of this project, given the closeness of their existing mill, and took cash, took shares, and took the royalty assets as consideration. So what we acquired is effectively a 1.25% net smelter return royalty over what is really the kind of core of the asset, the Gloria and Abundancia veins, which Avino has flagged will be the two that they will start mining first in that order. And then there's a 2% gross value royalty over effectively all the surrounding tenements of La Preciosa, including the Martha vein, which is sort of the third vein to be targeted, but further on in the mine life. And then along with the royalties, upon first silver production, 12 months thereafter, there's a milestone payment that's due to the royalty holder of $8.75 million. This can be paid in up to half in Avino shares, and it's a very liquid company, good volumes trading in the U.S. and Canada. So from our perspective, we paid $8 million for the asset. So as you can see from the milestone payment alone, we'd expect to see ourselves in the black, and then from there we've got a plus 30-year mine life on our expectations where this royalty would be paying us. We've been seeking good silver exposure for some time. We like it as a commodity. Obviously, it's a store of value similar to gold, but has very substantive industrial uses. In fact, we flagged in our announcement that over 50% of silver is actually used for industrial purposes, and increasingly that's weighted towards solar panels, towards EVs. Silver is obviously the best conductor of electricity from a cost perspective. Copper is obviously used more frequently, but there are instances where silver is more cost effective and more efficient. And so we're seeing it used more and more for those sort of transitional functions. So like to have it in the portfolio. We think it complements a lot of our other assets well. With regards to the asset, I flagged it's a very significant project. The one thing I didn't flag is the nearness to cash flow. Avino has been very public, and in fact, their quarterly, which was just reported on last week, they flagged they're still targeting commencement of processing some stockpiles from Preciosa before the end of this year, and then targeting fresh ore in 2024. So very near to cash flow, and obviously once they start producing silver from the property, that starts the clock ticking on the milestone payment. And then they flagged their target of growing substantially up to 3 million ounces of production from this property by 2027, increasing to 3.5 million ounces. Obviously, we took our own internal view with regards to pricing the transaction, but anecdotally, at 3 million ounces and $25 silver, this royalty would be paying the 1.25% would be paying circa $1 million to 1.1 on a pre-tax basis. So, on that basis, and with the assumption that the milestone payment would be paid, we found it to be a very compelling transaction. So, very pleased to have it within the portfolio. And I think we'll skip over some of these because we've touched on them in a number of other presentations. Happy to circle back in the Q&A. But I think wanted to jump ahead to just the general growth catalysts. I think one very important thing from our perspective is we've been able to talk throughout this presentation about the accretive organic growth within our portfolio. That's not something we've always had the ability to talk about because we're a fairly young company. We're not yet 3 years old. And in the early days, it was purely our acquisitions that would lead to an increase in NAV per share and therefore an increase in share price. We're now in the pleasing spot where positive events like Thacker Pass, like the growth of the offtakes portfolio, the outperformance of Kuyunabing this recent quarter, all these events and more add organically to our NAV per share. And then, of course, we're always looking for new transactions like La Preciosa and others that we're working on at the moment. So we feel like we're in a very, very comfortable position where, flipping to the next slide, where we've got a good cash balance to deploy into our pipeline. This is the 37 million as referenced in our Q1. Obviously, we made the Preciosa transaction subsequent to that, which was 7 million up front. So you can sort of right size that for that transaction, but still quite a bit of firepower. And I think the biggest cash balance we've had at our disposal since inception. So between the ability to use our balance sheet cash, potentially to upsize debt, as you saw in Preciosa, there is a scrip component to that linked to the milestone payment. We pay 1 million over across the core in shares or cash at our election. And for existing royalties, we've always had a scrip component. It allows us to really expand the portfolio while stretching and making the most of our balance sheet. Of utmost important to us is managing the share capital dilution. It's a tricky balance, one that I think savvy investors in the royalty space have seen peers doing that with varying degrees of success. So it's something that's very much at the top of our radar with regards to managing appropriately. So with that, I think we've touched on the bulk of the key messages we wanted to get across. As we said, we wanted to approach this webinar a little bit differently than the one from a few months ago, and really spend a lot of time on Q&A. So with that, I think we'll pivot to questions.
Adam, Richard, thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. Adam, Richard, as you can see, we have received a number of questions throughout today's presentation. And if I may now hand back to you, Adam, and kindly ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end. Thank you.
Perfect. Thank you. We'll start at the top here. So the first question is, do you have a firm date in mind for a maiden dividend? Richard, perhaps I'll let you answer this one.
Thanks. So dividends are a topic we've touched on in previous webinars, and they're certainly going to be a big part of the future of the business. I think as we've answered this one previously, given that a number of our royalty assets are still at the development stage, and we have a number of calls on our cash flow as we're looking to grow the business and reinvest in new acquisitions, we obviously don't pay a dividend today. But as those bigger assets come on stream towards the middle of the decade, I think that's the natural point where we would look to introduce a dividend.
Yep. Let's see. And the next one is, what is the IRR on the new silver royalty? Is it greater than 15%? And the reference to 15% there is we've always flagged that our target blended portfolio return is sort of mid-teens or higher, and that's clearly a number that shifts around as we see interest rates rise. That has a knock-on impact into terms of how we would be viewing our requisite return profile. But anyways, the short answer is yes, we see this as north of 15% post-tax IRR. IRR is obviously heavily weighted by the time value of money. So with the milestone payment as front loaded as it is, really the expectation is we recover our capital in pretty quick order relative to royalty. I think most royalty transactions you'd be familiar with, it's not uncommon to have a 7 to 10 year sort of recovery period. This one, the expectation is that it would be fairly quick, given the references I made to Avino's guidance on targeting first production from Preciosa. So when you recover your capital that quickly, it has a sort of outsized impact on IRR. So we see it as a very substantial return. Let's see the next one. Perhaps I'll let you run with this one, Richard. It's would we consider a monthly dividend versus, I suppose, quarterly, which is probably more common.
Yeah, thanks, Adam. As I said, the dividend is still a little way off. I think at that point we would have to look. Certainly, monthly dividends are less common here in the UK. I think more quarterly or biannually is normally the way they're paid. And from a cash flow perspective in the business, you know, a lot of our royalties pay on a quarterly basis. So I think it's probably unlikely that we would go monthly on a dividend.
Yeah. Let's see. The next one is what is the potential downside if this Sonora issue goes south? Do we think that this potential has been priced into the recent share price drop? Well, it's a bit of a complex one to answer, but I think going back to the structure of that particular acquisition, I'd encourage people to actually to look at the original deal announcement from January of 2022. It's a pretty lengthy announcement given the way it was structured via a JV with a loan to the JV and a put option. So, but effectively the end result, as I said, is effectively a synthetic option, such that if it goes in the right direction, then we have the ability to acquire 50% of the royalty, and we've got that option until January 2025, or 6 months after first royalty receipt, the earlier of. So there's a world where this thing produces, the litigation's resolved, we can see what the first royalty payment looks like, and then make the election to sort of pull the trigger on the option. If it goes south, as the question asked, then kind of what's the scenario for Trident? And that's, we put down the $2.5 million loan, effectively as a deposit, and that's recoverable and it's collateralized. So if it goes against the royalty holder, then effectively we can call that loan, get our money back. So has this downside potential been priced in? It sounds a bit glib, but there's really kind of no downside potential in that scenario. We hate to lose the opportunity to get that royalty because it has the ability to be world-class. But we effectively don't have capital at risk in that regard. So it's purely sort of an upside scenario from our perspective. So it's something we're obviously following closely. A lot of thought went into this transaction, as you can imagine. And we've revised it once subsequent to the original acquisition in January of last year. Then I'd encourage you to look in, I think it was July of 2022, where we revised some of the terms. Mexico's obviously made rumblings about nationalizing lithium assets, and they have done so, but not on existing licenses. Still, that's a situation that makes us a little uneasy. So we added as a conditionality to the transaction, we need to have clarity on nationalization risk. So from our perspective, this is has a lot of upside potential. One we're going to monitor very closely. We have been to date. We've made adjustments to try to accommodate for risk. We'll continue to do so, but I think that's how we're approaching this one. So yeah, with regards to potential downside and how it's been priced in, when we saw the sort of dip on that news, it was a little bit surprising because it's sort of an aggregate 20+ million in market cap that was dinged off of us for what is sort of a purely upside option. The next one is, are you aware of the Cornish Metals, South Crofty, Cornwall tin and lithium mine coming online in the next few years? Richard, I'll let you answer this one.
Yeah, that is an asset we know, and we've watched Cornish Metals. I would note there's already a royalty on that one owned by Cisco, so whether there'll be room for additional royalties, I'm not sure at this stage, but it's certainly an asset we know.
Yeah. Next one is the price of lithium has gone down threefold since November 22, although it appears to have stabilized in the last few weeks. At what lithium price might Thacker Pass cease to be attractive? and when would the royalties start being at risk? Yeah, I think one thing to sort of underscore here is, and we've said this before, but when we priced the transaction, we were using a long-term lithium price of $12,000 per ton. The long-term consensus price has crept up pretty substantially since then, sort of north of 50%. So I think we're very comfortable with the economics of our acquisition, without a doubt. When might Thacker Pass, the asset itself, cease to be attractive? It's flagged as being a first quartile asset. I believe the feasibility study, which was published in February, flagged a $7,600 cash cost per ton of lithium. So it's a very competitive asset. So I think, and it underscores the strategy in the sense that it's a very defensive asset. There will be cycles, particularly in commodities that are not exchange traded. So a little less of volatility as you'd expect in things like copper and some of these sort of more the exchange traded commodities. I suppose something like lithium, there's still quite a bit of volatility. I think we see that as positive. It will settle down as production comes online and it becomes more normalized over time. But from our perspective, you have this ability where prices can go berserk, and as a royalty holder, you can really benefit from that. But yeah, with regards to the Thacker Pass asset, it's a very defensive, attractive asset, I think, through all cycles, is our view. So the next one's related to dividend timing as well. Although Richard had asked a little bit more about level of yield we might be aiming for, how we'd be thinking about proportion of free cash flow, those sorts of things. So maybe we could add a bit more color around how some of our peers approach this and how we might be thinking about it.
Yeah, I don't think we target a level of yield itself. I think once we get to the middle of the decade, I think we'll have to look from a capital allocation perspective at the opportunities in front of us, and then obviously split the cash flow between paying a dividend, which we would hope to be sustainable. So we don't want a dividend that's whipsawing around year on year. So I think we would probably start relatively modest and look to have that as a stable dividend, possibly growing over time. So I think that's how we'd approach it. But as we've talked about through this call, prices do move around, cycles move around. So who knows, in 2 years' time, we may be in a very different spot. Lithium pricing could be very high, or it could be where it is today. So I wouldn't want to make too many predictions on exact levels.
Yeah, perfect. The next one is, will you update us on the situation with regard to the proposal to nationalize lithium production in Chile? This is obviously something we follow closely as it relates to the broader lithium market. But of course, we don't have any lithium assets in Chile. So we're not directly exposed. Kind of inversely, it's actually slightly a positive for us. And you would have seen that reflected in some of the lithium producer share prices when this news started to break with regards to potential nationalization in Chile. Because it means sources of supply from other jurisdictions become more favorable. So from our perspective, generally sort of a net positive, but obviously something that we're monitoring. The next one is CATL, the Chinese company that's the world's largest battery producer, secured lithium at 70% discount to the spot price. With reference to Thacker Pass, would there be a reasonable expectation that sale prices to GM will be at a significant discount to market prices? Yeah, perhaps we both answer this one. The first snippet I'll provide is it kind of goes back to one of the previous questions, where that this is not a sort of cohesive exchange traded commodity at this stage. That comes with both positives and negatives. Lithium's obviously had some swings and roundabouts, but I think with regards to some of the more recent news we've seen, we did note the CATL securing of lithium at that price. We also noted Tianqi and Ganfeng flagging that they will be selling at a floor of 36,000 a ton, which is, again, well in excess of the original 12,000 a ton we were pricing in as our long-term lithium price. So I suspect there's going to be continued both positives and negatives in this space. with regards to how it directly impacts Thacker Pass, remains to be seen. The offtake with GM has not been made public. We've got a little bit of insight there, but we're not able to disclose anything, and we don't have any non-public information in that regard. But we do know that it was very competitive offtake process. We know a large investment bank ran the process, had a number of bidders for that material. As you can imagine, it was very sought after material, being US sourced battery metal. It qualifies for some of the tax incentives under the Inflation Reduction Act and other kind of favorable treatments. So it's very, very competitive material, unlikely to be priced at any real meaningful discount is our view. Richard, not sure if you have anything to add to that.
No, I think that covers it.
Yeah. Does senior management have their own skin in the game, excluding any options from salary? Are you continuing to buy? Yeah, so I think you would have seen purchases most recently from myself in December, late December. I think Richard was in the same time frame, perhaps had a couple of purchases. Speaking for myself, sort of 100% leverage to Trident. The performance of Trident share price hugely impacts my personal position. And I think I can speak for the rest of the team when I say similar for them as well. We all got into this for the equity exposure. None of us were sitting on heaps of cash to begin with, and when we started the thing, it was effectively a shell company, so there was no guarantees of salaries and that sort of thing. We had to make the thing a success to see it play out from our personal positions. So very comfortable in saying we're very much aligned with shareholders in that regard. Let's see. Next one is, could you elaborate on the competition for deals? Do you expect consolidation in the industry? Richard, I'll let you run with this one.
Yeah, I think as we looked at the slides earlier in the pack, there are a lot of companies in the royalty and streaming space, particularly on the precious metals side. So I think that part of the market is particularly competitive. I think as we move across into base metals and bulks, it's slightly less competitive. But we do normally, we do normally come across some of the other players in the market when we're looking at deals. I think we're lucky that maybe our niche and our deal size is sometimes slightly smaller than some of the other companies, so it does open up a bit of an opportunity. And then on the consolidation point, we've obviously seen in North America on the precious side, there've been a couple of deals in the past sort of 6 to 9 months, and I think logically there may be some more consolidation to come.
Yeah. See, the next one is there an upper limit to the size of an individual deal in terms of spend? We certainly don't have a hard limit. I mean, our largest transaction to date was just below 70 million US. Now, obviously, that was for a portfolio of assets, so slightly different situation. I think it comes back to some of the dilution and capital points that we raised earlier, where we want to manage that as carefully as we can. Going out there and doing a large transaction that's going to blow up our share register is not in anybody's interest. So I think we want to grow aggressively, but we just need to make sure we do that the right way, and it's at the forefront of our minds. Are there discussions in place to reach a negotiated agreement in respect of the Sonora asset? Nobody likes to see lawyers getting rich. Agree with you there. I think from our perspective, we're sort of one step removed. Obviously, we're not the royalty holder today. We've got the ability to be a royalty holder in the future under the right conditions and upon completion of the transaction effectively. So we're one step removed, and we're sort of leaving it for the parties that are involved to manage that process. Let's see, for the non-expert investors like myself, how does Trident monitor the real happening in numbers of La Preciosa within the Avinos silver on spot operations? How does the monitoring process work? How much internal and outside resources does it take? Richard, I'll let you address this one.
Yeah, traditionally with these royalty agreements, we certainly have information rights, so we often receive reports either on a monthly or quarterly basis, and have the opportunity to visit sites. Often, once a year is a pretty standard term in a royalty agreement. So, depending on the size of the asset within the portfolio, we'd certainly obviously look at the information, possibly go to site on maybe not every year, but we would go and monitor. We don't have people there every day monitoring what they're doing and how things are going. Given in Preciosa's case, it's operated by a listed company in North America, so there's a very good flow of information that we can monitor what's happening. But our model is pretty lean, given that we're not operating. We don't need to have a huge staff of technical people looking at each operation. So we do monitor things, but we're not investing huge resources in doing that.
Yep. The next one is, how does the high interest rate environment impact acquisitions of royalties versus low interest rate environment? In general, is there an interest rate cycle that's more or less attractive for Trident's business building? Yeah, it's a good question. I think there's a couple angles of impact here. One is obviously as the cost of capital increases, our return profile sort of naturally needs to increase in tandem. The flip side is for the mine operators, if they're contemplating debt, they're seeing the direct cost of that debt increase as well. So in some cases, it can sort of push a mine operator into the arms of a royalty company because the debt may just be so unappealing. It comes down to mine operators have to make a determination between raising equity, which at current share price valuations may not be attractive to the operator. If they've got the capacity to go out there and raise debt, which they tend to have to be a producer or entering into construction. But if they got the capacity to go out there and raise debt, then they then have to ask themselves whether it's the sort of covenants that come with the debt, whether that's appealing to them and allow them to execute on their strategy as they want to. Because that's the real appeal of a royalty is yes, we clip cash flow, and unlike debt, we're there in perpetuity in most cases. So we don't disappear, whereas you can refinance debt over time. But the strong benefit of a royalty is it's sort of hands-off capital. We don't have strict covenants. They pay us a percentage of their revenue. If their revenues ding, they don't have to worry about tripping over their covenants and ratios and potentially getting themselves in trouble with their lender. It's very covenant light, and that gives the operator flexibility. So I think in environments like we are in today, I think we see a higher value placed on that flexibility from the mine operator's standpoint. So we find it is a pretty positive time right now to deploy capital. And this is not dissimilar from sort of my previous life in mining private equity. There's a good times to deploy capital and good times to sort of sit back and let the market cool off over time. And I think from our perspective, we're in a good position to deploy capital at the moment. Next one is, will you consider oil and gas royalties? Richard, I'll let you answer this one.
Thanks, Adam. No, we're generally focused on the mining sector, so oil and gas is not something we look at.
Yeah. Let's see. Typically, how many companies are you in negotiations with underneath the radar at any one time? As you can imagine, it varies pretty drastically. As I've alluded to, we're finding ourselves pretty busy at the moment. I think we're at a point in the cycle where mine operators and developers' share prices haven't recovered to where they maybe last raised equity. So equity is looking pretty unappealing. And in many cases, if a project's not in operation, that they don't have the option to go out there and raise debt. So royalty financing to continue to progress their progress, because no management company is incentivized to sort of sit still. So throughout the cycles, they need to progress their company and the underlying assets. So I think we're finding it is a pretty opportune time to go out there and deploy capital. With regards to total number of companies, it oscillates wildly. I'd say we're probably at the upper end of that range where we stand today. In terms of a bit of color on pipeline, because we're often asked about that, I'd say it's weighted towards base metals, base/battery at the moment. Seeing quite a bit of copper, which is very positive from our perspective. We'd like to get more copper into the portfolio, so very focused on trying to progress some of these ongoing diligence processes. Let's see. From your discussions between the more knowledgeable U.S. Canadian royalty investors, what are the less experienced UK investors missing when reviewing Trident as an investment? Richard, why don't you take that one?
Thanks. It's an interesting question, and whilst royalties maybe haven't been quite as popular on this side of the Atlantic, we're certainly seeing over the past 3 years there's been an increase in the knowledge base, if you could put it that way. So a lot of the investors we talk to on the institutional side are now pretty comfortable with the model. You know, you've got Wheaton who are cross-listed over here. So on the whole, that I wouldn't say there is a big gap. Possibly one area where more mining-focused investors from Toronto and New York maybe look a bit more at the optionality and the exploration potential and the sort of the long-term upside of some of these assets, and possibly that's what helps drive certainly the big multiples that the three major players in the sector enjoy. I think maybe that's one point that's maybe a bit less either understood or paid for over in the UK.
Yep. Let's see. And do you think the U.S. listing may bring attention to the non-precious metal royalty model and bring in more competition? I don't think that's a risk we see as eventuating right out of the gate. It's going to take up time to build a following. Effectively, the OTC listing is very suitable for U.S. and North American retail investors. The big institutional investors can build a position through our AIM listing, so that was never really an impediment for them. So it's a bit of a building process, and I don't see it as necessarily shining a light on us in a way that the non-precious focused royalty model. I don't see it as sort of introducing new competition necessarily, so don't see that as a risk. See, the next one is, what is your preferable shareholder structure, if any? What can certain shareholders bring to the table? Richard, how about you tackle that one?
Thanks. I think when you look at our register at the moment, it's pretty well diversified. We've got a few holders at sort of 10%, 8% and lower. I think that's how we'd like to keep it. Obviously, we've done deals with parties such as Orion where they've taken a chunk of stock and sold down over time. We're certainly not averse to vending in assets for a shareholding position if the deal is right. But I think on the whole, it's better to have a wide and diversified shareholder register.
Let's see. The next one is, will you consider long-term publicly listed warrants? Short answer is no. That's nothing we considered to date.
Adam, Richard, thank you very much for addressing all those questions for investors today. And of course, the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But perhaps before redirecting investors to provide you with their feedback, which is particularly important to the company, Adam, could I please ask you for a few closing comments?
Of course, we wanted to thank everybody again for dialing in. As I said, we wanted to take a slightly different format with this one, and rather than spend too much time on the slides, wanted to field any questions, and we got quite a few. So hopefully everybody found this to be helpful. And as always, please follow us on social media. We're on LinkedIn, Twitter. Please sign up for our news feed on our website. We like to keep investors as informed as possible, so we'll make sure to do these frequently. So thank everybody again.
Adam, Richard, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Trident Royalties PLC, we would like to thank you for attending today's presentation. That concludes today's presentation. Good afternoon to you all.